Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And typically joining me would be Mr. Michael Becker, but he's enjoying a few days off through the Thanksgiving holiday. So sitting in the podcast today, the professor himself, Mr. James Eng. James, how are you?
Great. Thanks for having me, Paul.
James, how was Thanksgiving for you?
It was good. We stayed in Texas, went down to Houston for a couple of days, and then back here in Dallas to wrap up the year.
That's good. Good time for everybody to get together with their family. Like they haven't seen enough of them for the last 9 months, but a few more days always helps. I was listening to CNBC this morning. They're talking a little bit about maybe the inoculation that's going to happen some period of time in the first few days of January, or possibly at the middle of December here, but thinking that probably about 50% of the population could get inoculated probably by the end of the second quarter of 2021. So hopefully that comes down the pike. So we are going to talk a little bit about something that we haven't really talked about in the past. And I think we couldn't find a better speaker to speak about this subject. And it's a friend of ours that we've known for a long period of time, that we've done business with in the past, that we thought that you should get some exposure to the business that this gentleman is in, because sometimes the product that this guy sells can be almost like a broken slot machine, that it continues to pay off and pay off and pay off and pay off for the investors that have invested into this type of stuff. So in the podcast today, we're going to talk with Robert Denninger. Robert is with Marcus and Millichap out of the Dallas office. Robert's a friend of ours. He sells, and he'll tell you exactly what he does, but he sells mobile home parks and recreational vehicle parks, not just in the state of Texas, but throughout the Southwest. And he's, an expert of this product type. And so, Robert, thanks for being in on the Old Capital podcast.
Well, thank you for having me, Paul. It's great to see you guys. As you mentioned, we've done business for a decade, I think. So it's good to see you again, and I'm excited to chat with you today.
I'm going to kick it over to James because James is the inquisitor, and let's go with James.
Hey, Robert, thanks for jumping on. What I wanted to do was sort of start at a high level and maybe give us an understanding of sort of why mobile home parks, and then we'll get maybe into the underwriting, financing, equity on these deals, and how people can sort of learn more. So maybe let's just start high level, sort of explain mobile home parks, RV parks to people out there. And maybe a lot of people are familiar with apartments, so maybe you can compare and contrast on that piece. So I'll kick it over to you and you can start going.
Sure. Thanks, James. Well, yeah, it's a great question. And it was one that I asked myself when I was trying to decide what product type I wanted to specialize in after coming out of management at Marcus and Millichap. And I remember a funny story. My regional manager, who I'd known at the time for about 10 years, said, "You need to go sell mobile home and RV parks." And I said, "Tim, how could you say that? That's insulting. I'm an apartment guy, and then I was in management, hiring and training guys. And why would you want me to get into that? And he said, "Look, I'll support whatever you choose to do, but at least do some research and make your decision based off facts, not out of ignorance." So he said, take 2 days and learn everything you can about the mobile home park industry, and then make your decision. I don't care if you go back to apartments or if you do self-storage or whatever. And it took me probably 3.5 hours. I read about what Sun Communities and what Equity Lifestyle, these REITs had done through the Great Recession relative to other real estate REITs. I read about what Warren Buffett had done with the manufacturing of mobile homes. I read about Sam Zell and the growth of his REIT. And I even read a book called Deals on Wheels. And I immersed myself in trying to understand all the different ways to generate cash flow in the product type. And it didn't take long at all for me to become convinced that if the equation is minimizing management headaches and maximizing yield, that this was the best thing I'd seen. I did have, I want to say, 6 or 7 years experience brokering smaller apartment complexes through the North Texas area. And I think that before we go much further, it's really important to distinguish some different types of mobile home parks. I guess we could say the most common is something called a lot rent park, where the owner owns the dirt of the asset and leases the dirt and use of the utilities to the owner of the mobile home. This is considered the most attractive model. The expense ratios are generally lower. We'll get into the specifics of that here in a bit. But the reason is because if and when there's a problem with the toilet at 2:00, the owner or manager doesn't get a call. Whatever happens within that physical structure is responsibility of the homeowner. So another type of park is something called a park-owned park, which you could also consider a horizontal apartment complex, where owner owns the dirt of the asset, owns the utilities underground and above ground, as well as the homes. The general rule of thumb that I've seen and heard is that a park-owned rent is generally going to be about 2.5 times lot rent for that same submarket. So your gross income is generally going to be substantially higher, but your expense ratio is going to be substantially higher as well, because you're responsible for what occurs not only within the park, but within the homes, so it operates much more like an apartment complex. The cap rates on both, which we can also get into the specifics in a minute, you're going to see a substantial increase on park-owned homes because your expense ratio is higher and your, headache element is going to be much greater just due to more management, more turnover. Residents are going to be less likely to take care of the home if they don't own it. Whereas on your lot rent parks, there's an incentive for those individuals to take care of their home. And a lot of times the idea is there's also kind of a rent to own model, which is where somebody can come in to a park, and for a down payment, I've seen a huge range. It could be $1,000. It could be upwards of $10,000. They get to move into the home for that down payment. And they pay down a note over a given amount of time. And once that note is paid off, they become a homeowner. And what a lot of park owners do to market that type of, situation is the idea is there's a huge part of Americans that have a dream of being a homeowner, and they can't do it the way maybe you and I can, but to have their own home in a park is something that's really special. And it's something that works in a lot of these communities. So what a lot of these parks start out as is kind of a hybrid model. Let's just, for the sake of easy conversation, say you have a 100-space park, and say you have 50 park-owned spaces and 50 lot rents. Well, the idea is that you want to possibly transition those park-owned homes into resident-owned homes over a period of time. So as new residents come in, you put them in the home, you get a down payment, and once they pay the remaining note down, they become homeowners. And by the time you want to sell in 5-10 years, well, now instead of having a 50-50 ratio, you're 80, 90, or possibly 100% lot rent. You can benefit from the lower cap rate and go sell at a premium with less management headache.
So Robert, maybe let's take a step back. I mean, we understand the demand drivers around sort of multifamily. Yes. And let's say in Dallas right now, the rents on, let's say, a C, B minus property are anywhere from $900 to $1,000 average rent. What are we talking about? And let's say in Dallas, there's 800,000 apartment units, average rent's $1,000 on a B minus deal. What are we looking at in terms of supply, in terms of rents for, let's say, a park in an hour away from DFW? Do you have any, just give us a little bit on that.
Yeah, great question. Right now in, I'd say, Dallas and Tarrant County, there's going to be more product in Tarrant County, but rents from a lot rent standpoint, there's going to be a pretty decent range there. And the way that most park owners and investors look at parks is based on the utility setup. And the more urban the park, or the more close to retail development or subdivision development, you're going to see city water and city sewer. That's a huge deal. It's a top 5 question on any park from an investor standpoint is what's the utility setup? That's going to have a huge impact on cap rates. But to answer your question directly on what lot rents are in Dallas, for your nicer parks that are on city water, city sewer, concrete roads, nice product, that are predominantly lot rent parks, you're looking at 500, 600, maybe even 650. Your REIT-owned parks are going to be a lot more in touch with what that submarket can handle. And I think what a lot of people on this podcast probably want to know is where's the opportunity? And that opportunity is largely in these diamond in the rough parks that are still out there that are owned by mom and pops who maybe have put their children through college, or they have graduate degrees, and now the children really don't want anything to do with this property. And it's just time to move that asset. And a lot of times what I find is that the mom and pop owned or the privately owned parks are the ones that are generally going to be below market. Probably not earth shattering. You guys probably see that in the apartment world a lot too. But, with some of the larger REITs, they're managing their lot rents on a daily or weekly basis. It's very just how, some of the larger managers in the apartment world in Dallas will do the same. I mean, they've drilled it down, but your range right now is going to be, 500 to 650, give or take, on the nicer product in Dallas.
Okay. And then let's just hit those. You said, all right, there's 5 questions that every investor asks you about a deal. So you bring out a new deal, blast it out to your email list. And then what are the 5 questions that you try to answer in that OM? Because you're going to get it anyways. So Sure. You said utility setup. So I guess that's hookups to water, sewer, electricity.
Yeah.
Okay.
Water, sewer is going to be the main one. And actually, let's go back to the top 5 questions. So first question is generally going to be, why is the seller selling? What am I missing here? What do they know that I don't? And the answer to that question, I really believe that the mobile home park world is broken into 2 types of players. You got your IRR driven guys, which I think is a lot of what you guys deal with in the apartment world, 3 to 5 year hold, maximize value, flip to the next guy, reap the tax benefits from that and the value on the back end. But the other sector is these parks that really have been generationally owned, 10, 20, 30, sometimes even more years. And, you have folks that maybe don't want to do the value add. They don't have the capital to kind of take the property to the next level. They have the cash flow, but that all goes to their bills. And the way that some of these owners handle their finances are just different, and so that's it's very separated. You have your sophisticated, your unsophisticated, and my job is to help them get along and make a deal. So first question is generally going to be, why is the seller selling? And oftentimes it's just the kids don't want the park, and it's time for the park to move on. Cap rate, price per space, obviously is going to be a question just to get a ballpark on where that property aligns with the rest of the market. Another thing that a lot of out-of-state owners want to talk about with Texas parks is what can they expect in terms of rent growth, population growth, average net income for any given submarket. We practically have a country that we watch over, because Texas is so big. And so what happens in, say, a smaller market in East Texas or down in, the Piney Woods or, a Lufkin and Nacogdoches or something like that's going to look different than maybe a Waxahachie or a Waco or a Temple or something that's on the I-35 corridor. And then, there have been years where a substantial amount of our deals have occurred in the Permian Basin. That's more on the RV park side, though. And obviously that's the Permian Basin is a huge up and down market. So there's so much variance, but oftentimes our out-of-state owners, they really need to wrap their heads around what can they expect over the next 10 years with any submarket. Not very different from apartments either.
So we got why the seller's selling. We got utility setup. We got cap rate. Anything else in terms of amenities that people should be asking about? Or like the question for me is, if this thing is some of the OMs that you sent me, these guys are 2 hours away from DFW. And my question usually when I look at an apartment is like, where do these people work? And so that's my question is, if you're 2 hours away from the closest city, are these guys all working from home? Are they working at the school district? Where's the tenant demand, and sort of how are they generating money to pay the $500 lot rent?
It's a great question, James. And the answer is, we've been surprised at how many, when we ask sellers that question, a lot of it is you're going to see a lot of oil and gas throughout the state, even in areas that may not seem like there's oil and gas. We see a lot of that in East Texas, Tyler, Longview. A lot of people they work manufacturing, they work at distribution centers, they work in logistics and things of that nature. And the other thing is a lot of these folks that live in these parks have kids that pay their rent and live somewhere else, and they don't want to go to the big city. It's a totally different lifestyle, and but I'm not, I mean, there's certainly parks we've listed and sold, and I'm wondering the same thing, so it's, every deal's a little different, and it really depends on the submarket. Every deal we list, especially if it's going to be in a smaller tertiary market, we need to really understand what are those drivers in that area. Sometimes it's colleges or I mean, in East Texas, it can be like Tyson Chicken. We see a lot of that. We see distribution centers, railroad. I mean, it's all sorts of things out there.
So I guess once we understand the demand, and then in terms of supply, is it, I live in Frisco, there's probably 4,000 units going up within 3-mile radius of my house. Like, is there supply coming on? Like some of the pictures that you sent me, it looks like it's just a bunch of land and a bunch of hookups. And so how hard is that to replicate, 5 minutes down the road? Can someone just redo that entire thing? And then all of a sudden I got, another 100 lots that I got to compete with.
That's a really good question. And there's a lot packed into that. So the first thing is that going back to the top 5 questions before we jump into this, one of the other questions I often get asked is there room for expansion? That's a huge question people want to know. Based off everything I've heard over the past, I guess, 3 to 3.5 years of being in this asset class, it seems like everybody in America can kind of agree that we have a housing crisis, especially for lower income folks. And I remember I was at a national conference, I think it was in New Orleans 2 years ago for manufactured housing. And there was a workshop that was for how to develop a mobile home park. So I remember I kind of stayed in the lobby. I was visiting with some folks, but I watched people go in there. Everybody was talking and excited about this workshop. And an hour and a half later, they come out and they're defeated and they're like, what in the world? And it was kind of funny. But I think what a lot of people learned in that is that it's not easy to build these from the ground up. It's much easier to expand in a park that has the proper zoning and all the bureaucratic powers that be are okay with the expansion. That's a lot easier way to increase cash flow than to think that you're going to be able to walk into a city and create one. The other thing I'd say is over the past 6 months, literally since COVID started, I feel like the amount of time and conversations I'm having with folks that are in the process of developing mobile home parks from the ground up, that are going to the board meetings with the city, that are getting the approvals, that are working through the utility setups. I'm seeing much more of that today than I was when I first got into the asset class a few years ago. And I think what's happening is some of these cities or counties are realizing that mobile home parks are still a good way to generate tax revenue if there's no alternative for that piece of land. And we have a lot of people that need somewhere to live. And I think we're going to see more of that. I'm not going to pretend to be an expert in that part of the business because I haven't closed any of those transactions. I've had a few developers approach me wanting me to plug in buyers, and I'm working on a few things right now with that. But it's just from the conversations I have on a daily basis over the last 3 years, it's undeniable that this product type I think is going to have to start growing. I also remember a few years ago, I was hearing that on a national level, it's a dying asset class, meaning on a net basis, there's more units that are being redeveloped into retail or some sort of other asset class than were being developed. And I don't know exactly where we are with that today, but I won't be surprised if we're going to see it go the other direction. But it all has to do with the stigma around the asset class and the fact that a lot of these bureaucracies or powers that be simply don't want a mobile home park in their community. And so there's one thing that was really cool also when I got into this product type is seeing how the new investor mindset in the asset class is very much, we have a responsibility for ourselves, for each other, and for our residents to do better and to make the asset class more presentable and to make it and to fight against that negative stigma. And I thought that was really cool. And I certainly see that with most of the kind of the newer money entering the product type.
Can you talk about why? So I understand, all right, look, there's a lack of affordable housing. There's, limited places that you can rent for $500 a month. And so the demand is that all these are full, essentially. I guess explain how the investment looks for somebody, right now, instead of buying a deal at maybe a 4 to 4.5, 5 cap and putting a Fannie or Freddie loan on a deal and getting maybe 5, 6, 7% cash on cash on an apartment deal right now. What does the economics of someone investing in a deal in a mobile home park, how do they look? Like, who are the buyers? What's your competition? Like, there was a deal that was last week here in Dallas. It was a $20 million apartment deal, and we had 30 offers on it. And 15 people invest in final. And $1 million hard day one to win that deal. So what are there bidding wars like that on mobile home parks? And sort of how do people set up their debt and equity structures on these deals?
So I think we closed 16 deals last year. We'll probably do 14 or 15 by the end of this year. And, I know the apartment guys really well here. I mean, they taught me the business of brokering, and it's not uncommon, like you said, for them to get 20, 30 offers, have 20 tours and do a call for offers. We don't do that. For us to get 3 to 5 offers and go under contract within 2 or 3 weeks of being on market is fairly typical. And I really can't figure that out. The other thing I'd say is it's a very, very small world, meaning a lot of these investors are friends, and there's some very big players, and they seem to get along really well. And a lot of them don't want to bid up a deal against their buddy. And it's so close, meaning these guys on a national basis talk so frequently. So I don't see that kind of bidding war necessarily the way that the apartment guys do. And I still wonder why that is, And, I mean, as a broker, I want to work with somebody that has the experience and ability to actually get the deal done. So we sift through a lot of folks that for one reason or another simply aren't qualified. They want to get in, but they just don't have the ability to either get the right debt or, they get spooked off by something or somebody says something, So it's a smaller world in the mobile home park world, there's no doubt, but it is growing.
Would you say a majority of the owners are individual owners buying on their own account? Are they syndications? Or what is your typical buyer profile on your deals, let's say in the last year?
Great question. I think in the 90s, it was a lot of individuals. I think it was really smart guys coming out of the RTC that had cash in the early 90s. And we know guys like that in the apartment world that, they bought everything for pennies on the dollar. And, today they won't buy anything because the good old days are gone, So there's still those guys out there in the mobile home park world. But the vast majority of buyers today are either going to be your REITs or they're going to be your syndicators that operate a lot like apartment syndicators. You're going to have a GP that puts some of his own equity into the deal. He's going to raise money through family and friends. He's going to hit a triple or a home run, and then he's going to be able to raise $4 million overnight. So we see a lot of that. There's a lot of those kind of rising stars in the industry right now.
And so if someone's looking at a deal and we're underwriting it, let's go back to that 100 lot deal.
Sure.
And you're, I don't know, $500 a month on the lot rent. Walk me through sort of the P&L on a typical deal, and what are some of the gotchas on the revenue side and the expense side, and sort of high level, like apartments. An A deal might be a 40-45% expense ratio, a B deal 50 to 55, and a C deal 55 to 60%. What should people, if they get a package from you and they underwrite the deal, what items should they be looking out for?
Sure. So the first thing I'd say is that for a lot of the diamonds in a rough that I mentioned from, these private owners or husband and wife that have owned forever, the books and records I get are oftentimes they're really rough, and that's putting it kindly. And anybody who watches this that's, tried to get to know an owner will understand what I'm saying in the mobile home park world. That's one of the big challenges we have is getting good financials from sometimes sellers that are very motivated. And so a lot of what we have to do is we have to have conversations with them and work with them to really understand what's real here, and how much of this is your personal life, how much of it is the park. So we see that. What I do when I get a set of books and records is I'm going to try and drill down I'm going to look at a T3, a T6, and a T12 on income. There's not, on a lot rent park that's healthy, that's mobile home, you're not going to see a lot of variance in any of those. And Corona was just fine. I mean, our product type was virtually untouched through Corona. RV parks had a lot more up and down depending on where they were in Texas, but the mobile home park sector, I would argue, benefited from Corona, if anything. So I'm going to drill down to a T3, 6, and 12 on income, and I'm going to take a look at the expenses and immediately try and find an expense ratio. And once I have that, I'm going to have an idea of whether or not we're in the ballpark. And if I had a good meeting with the client on the first, I'm going to have an idea of what they think the property's worth. So in a matter of 2 minutes, I can have an idea that this is probable or not. If my expense ratio is 60, 70%, then first thing that's going to come to mind is they're paying themselves to manage a fee that's much higher than market. I've had deals fairly recently that have substantial water leaks, and nobody's looking at this for 20, 30 years. And the water's just, I don't know where it goes, but so utilities that haven't been kept up with. But I mean, generally speaking, these things are not that complicated. A lot rent mobile home park is not a complicated model. It's really not. And then, if it's an income issue, I'm going to be doing a rent survey within the submarket. And I like speaking with owners more than managers because I think managers sometimes will pump their numbers a little bit. So
can you talk about management? Because a lot of times, let's say there's 100 units, you can maybe afford one in, one out and get someone to pay, you maybe do a 4%, 4.5% management fee. And then, once you get up to 200 units, you got 2 in, 2 out and a 3% management fee on apartments. What's sort of the rule of thumb for these mobile home parks?
Another great question. I was shocked when I got into mobile home parks about 3 years ago that there was not a very competitive property management side to this business, at least for, 150 site parks and below. I mean, I'm going to say 90% of the deals that I look at are going to have, just somebody who lives at the park or lives within 5 miles of the park that likely has known the owner of the property since they bought it. Sometimes they've been there through multiple owners. And, if it's one person, they're going to have kind of a tough, get that rent bulldog side and also a sweet, somewhat salesmanship side. Oftentimes it's going to be husband and wife. But this, when I was brokering apartments, I remember how, we could Google right now, Dallas apartment property management companies and probably have 100 or so different groups. That's just not the case in the mobile home and RV park world. One of the biggest complaints that you'll see from owners is struggling to find a trustworthy manager. So if you can buy a park that already has somebody there that's kind of proven themselves, that's huge. And that's also one of the, I'd say, top 10 questions I get is the management turnkey and how long have they been there? One thing I've also noticed is managers that have substantial hotel experience do really well with RV. And sometimes apartment managers can do really well on the mobile home side. It's not that different. It's really not. On a lot rent mobile home park that's full, there's really nothing to do. I mean, you cut the grass in front of the office and collect your money, and it's beautiful.
So if somebody wants to get into this thing, and let's say it's a $10 million deal, make the numbers easy, a $10 million deal, and what should they expect at sort of a rate of return, cash on cash, IRR? What should we be looking at in comparison to an apartment deal right now?
Sure. Well, if it's going to be that size of a deal, it's likely going to be large. It's likely going to be in a major city. And, right now I know of deals that are under contract with money non-refundable in the state of Texas that are sub 5 cap lot rent park deals. I don't think that was the case 2 or 3 years ago. At Marcus, I get access to our retail guys and our apartment guys, and we all know that the market is just absolutely starved for yield. We're all trying to figure out where can I take a buck and make the best return for me. And so we're seeing that cap rate compression in our asset class here as well. So if you're going to be in a big city on 35, 45, or 20 in the state of Texas, all lot rent and good utilities, you're going to be paying something probably somewhat comparable to an apartment complex. Probably a little bit higher, half a point, quarter point. I think the best opportunity for mobile home parks is going to be in tertiary markets that have a population growth. If you can buy one from a mom and pop that has lower rents than the rest of the market, I mean, that's really where you're going to capture the most yield. But if you need to eliminate risk or at least bring it as low as possible, a lot rent park on a major Texas highway is really hard to beat in terms of minimizing your risk.
On those tertiary market deals, are those like $1 to $5 million? Is that what you're seeing in terms of pricing for those deals?
Yeah, I mean, sometimes lower, sometimes a little higher. I mean, we've done deals in I mean, recently we did a deal near Possum Kingdom Lake. That was a larger deal. But I mean, we're at a point now where I'd almost consider that path of progress for Dallas. There's a lot of folks that have a home there these are folks that live in Dallas and have a lake house. They consider it a lake house. It's a much different kind of resident base than somewhere that may be an hour closer to Dallas, but that's where people live, So every park kind of has its own story. One thing before I also forget, James, that's really unique about this asset class is that when I was brokering apartments, to have an owner and seller meet in person or have a conference call was a little bit taboo. It's something that as a broker, you didn't necessarily want to have happen because you saw it as your job to kind of manage and control the process for both the buyer and seller and kind of avoid that awkward tension if possible. I have not closed a deal where the buyer and seller of a park have not met in person or spoken on the phone. And what's unique about this asset class is each property is so unique and it really does have its own story. And you can look at a park and have no idea if that's a park-owned park or a lot rent park or how many of them are on loans or contracts. And so there's a lot of details that go into it. Now, I know I just said a lot rent park is really not complicated and may sound like a huge contradiction, but a pure lot rent park is very straightforward. But when you start adding some park-owned, some lot rent in a tertiary market with different economic drivers, it can be very difficult for a buyer and seller to not get to the finish line without having a conversation, which really didn't happen in the apartment world.
I mean, thank you for all the information. I guess from a person who is just getting into this business, what's let's say the first 3 things that someone should do the same way that, your manager said, hey, go read about this stuff for a couple of days and come back to us with some information. What should a person who's looking to get into this space, what should they be reading? What should they be listening to? What should they be watching just to get a feel for, is this something that I want to do? And maybe it's not necessarily in place of multifamily, but maybe it's in addition. I've already got my A-class deal that's getting $1,500 rents. I got my B-class deal getting $1,000 rents. I got my mobile home park getting $500 rents. So all across the spectrum, I'm covered. How do they sort of get started in this space?
Yeah, that's a really good question. I would say that the first thing is putting a good team together, putting the right people in place, because going into a new asset class, even if you have a lot of success in another, can be a bit daunting. And having the right team in place, attorneys, mortgage brokers, all that is going to be vitally important. And I don't think that's exclusive to this asset class at all. And I would say, get to know every broker out there. That's not self-serving for me, but you got to know what the inventory is. When you have access to the inventory and you can do your own underwriting, you can start to figure out what yields are actually reasonable in any given market and what is the norm out there. The other thing that's really tough in our state is getting actual sale comps. It's the constant Texas struggle. And so if there's ever a way to figure out what properties actually sold for, that's gold in our state, being non-disclosure. And then, before putting an offer in on anything, I just think you need to underwrite a lot of deals. You need to understand the differences between a lot rent property and a park-owned property. But one thing I've noticed is sometimes folks from other asset classes will come into the mobile home park arena and they will have a feeling that they can come and just easily get a 10 cap deal and ride off into the sunset. And not to be negative whatsoever, but the secret is kind of out. There's been some great press in the Wall Street Journal, a lot that's been floating around on LinkedIn. And, I feel like the stigma is fairly quickly kind of dying. And with the cap rate compression we're seeing everywhere else, it is competitive, and we're starting to see more competition in some of the tertiary markets. The thing that could be a blessing and a curse is future development of mobile home parks. We could have more product, could be good for tenants, good for the country overall. But we could see possibly, some saturation of product that could affect rents or growth. I don't see that anytime on the horizon. But I think just gaining some experience through your own model and really figuring out what's real is important. Understanding expense ratio, what should be the norm for a park in an area and what you can do to add value on expense reduction or income growth is going to be really important. I've sold, parks in the low 30 percentile on expense ratio and had no pushback. And, I'm working on a few right now that are very high, largely because I'm not going to represent something that I can't get complete clarity on. And if the P&L says that, the P&L says that,
That's all I had, Paul. Any other questions on your end?
Well, just a couple. Not in my backyard has really been the cry for mobile home park ownership groups for the last 70 years. So those ownership groups have really gone outside the community of the central business districts of whether it's Houston or it's Atlanta or it is Chicago. You have to go farther out in the country to kind of take a look and see where these mobile home parks are actually at. So they're not just going to be in the central business district. There are going to be a few, and a lot of them are probably grandfathered in, but there's really not a lot that are being built these days in the large metropolitan areas. And so that's one thing. So you're typically going to have to go out to the secondary, tertiary markets to find the mobile home parks. Second thing is the quality of the mobile home park itself. So you have to look at what the amenities are on these properties. Sometimes there's paved streets. Sometimes there's lighting on the property itself. There's overhead lights that the county would put in. Well, if you own all this land, it's on you're the ones responsible for the lighting on the property. Maybe there's curbs on the property. Maybe there's a pool and a clubhouse. So you got to kind of figure out what the amenity package it comes with, whether it is an RV park or a mobile home park. And then take a look at the homes themselves. Is there skirting on the property? Does it really look like a house, or does it look like something that Ricky and Lucy were in 1957 when they were trying to haul the trailer out? We see that in areas of South Florida, Northern Florida, some parts of Texas and Arizona, where these mobile homes are older properties. They still work, but they're 40 or 50 years old, and kind of see what that's all about. And then if you do own a mobile home and you lose it, like you're making payments to the property or you're making payments to the bank, whoever owns it, you stop making payments and you stop paying your fee, your space rent. Can you take that mobile home house back? Can the park buy it back at a discount because the landlord or the bank, whoever owns this deal, does not want to be fought with trying to put it on another piece of land? So maybe you can buy it at cheaper dollars on the property. There's a question coming up here someplace, Robert, but what also too is financing. Financing on these properties are not, on some of the higher quality properties, you can get Fannie Mae and Freddie Mac or CMBS financing, typically higher loan amounts, higher quality assets, properties that you're going to compete against with the REITs going into these properties, these products. Sometimes you can buy these properties from REITs. They're trying to make positions maybe to sell it, or they don't find it useful anymore that in their portfolio that they want to sell it. So you talk with guys like Robert and his team over Marcus Millichap out of the Dallas office. They kind of figure out what they're transitioning out of and that you can possibly buy into. So I threw out a lot of things out there, Robert. Is there anything else that we want to kind of talk to people that may be interested in mobile home parks or RV parks? What else should they know?
Yeah. One last point, speaking about financing, is a lot of lenders are still a little ignorant or a little fearful about the asset class. And what I've noticed in the deals that we've closed is the vast majority of these deals are done because of a relationship, because somebody was really good at apartments or retail or whatever, and they got their lender to do a deal. A quick story: a good client of mine was he wanted to buy a park out in the Permian Basin, an RV park, and he needed to get it done before the end of the year for tax reasons. And he had a lender back in Kansas, couldn't get anybody in the Permian to do it, so he put his lender on a plane and basically said, like, if you don't do this deal, you're not going to get my refi business. And he did the deal. And, we see a lot of that. And the good news is generally speaking, once a lender gets in on a deal in this asset class, they generally like it. And that worked out well.
Yeah, that's certainly true. Again, if it's a bank deal, typically that's a recourse loan. And a lot of recourse lenders do not like to have the syndication model. So they like to have like one or two or three rich people that want to sign their name to the loan. So that's one thing to be observant on. If it's a higher quality park and it has those amenities we were talking about, that curbs or pools or tennis courts or different things that are highlights within the park itself, maybe a Fannie Mae or a Freddie Mac loan is possible in that. And typically it's $5 million and above loan dollars on that. But, just know that you got to work with somebody like Robert and his team to actually get the first step going into this deal. You can't call the REITs. You can't, sometimes you can talk with the mom and pops, but you really want to have an expert to kind of hold your hand and guide you and get their opinion about, should you be putting money into this area, should be money into this property, this park, and what can we do with this property? And you want to really talk with Robert and his team to get their advice. Anything more that I forgot to mention, Robert or James?
Well, one thing I'd say about amenities is I have seen parks, even larger parks with no amenities, that are marketed that can almost be an asset, to not have that added expense or liability. And I don't know if you guys see that at all in the apartment world, but I think there's certainly buyers out there that prefer a very low to almost no amenity property. But I also have other buyers that want a swimming pool. They want a clubhouse. They want more of a community feel. And I don't think our industry right now necessarily thinks one is better than the other. I think it really comes down to the individual asset and what the goals are of that investor.
Yeah, I would also say that if you go to areas of like South Arizona, South Texas, and Florida, you have a lot of the snowbirds that move down there during the wintertime, and they're going to kind of require you to have some type of amenity package to that property itself, whether it's a lake that they can bring their grandson to go fishing on, or shuffleboard or pool activities to the property. They're going to demand it. Now, if it's a park that's in the middle of hot Midland, Odessa, there maybe not. Maybe that doesn't make too much sense. But the snowbirds are definitely going to want to have some activities. And then there's mobile home parks that have RV sections to them too, and they kind of look different. One of the things that, again, Fannie and Freddie do not want to do is that they want to make sure that the ownership of the park or this person you're selling for does not have a preponderance of park-owned homes, because these homes are fairly nice, but they also look at them as almost old Cadillacs that are sitting there, and those Cadillacs depreciate pretty damn quick, and they don't want to make a real estate loan onto a piece of chattel like a car or RV or a mobile home that's going to depreciate fairly rapidly. So they really want the seller to not own a lot of the homes. At least that's Fannie and Freddie. Now the banks, they really don't care too much because they're going to take an interest in that property, that chattel also besides the land. So it's kind of ask your lender, ask Robert again what the right direction is to how do these deals get financed. James, anything more?
No, I was just going to add that, when I was at GE, we essentially had maybe 2 or 3 asset types that we lent on even through the Great Recession, 08, 09, 10, that we did not have to take back at all. And that was number 1, apartments, number 2, self-storage, and number 3, mobile home parks. So I think they're even now more so than ever in terms of demand, in terms of lack of supply, in terms of affordability. I think it's a great asset type. And I think you're going to have to do a little bit more homework than you are in the multifamily space to get into it. But I think once you get into it, I think you'll be rewarded with good cash on cash, good just economics of the deal. And so that's why we wanted to bring Robert in today.
Robert, you got the last word. Anything else?
Sure. I guess just speaking about kind of what you were talking about, Paul, lenders generally will not underwrite park-owned income, period. Sometimes it'll be a separate note entirely, or there will be no note offered. So it's really important that if you're looking at a mobile home park, you're able to isolate exactly what the lot rent income is on a P&L, because a lot of owners will put it all together, and that's not really going to get you down the line. You need to be able to know exactly how much of that is lot rent, because lenders will happily loan on lot rent. Does that make sense, Paul?
No, it absolutely makes sense. These properties, they do depreciate fairly rapidly, but that's a little bit of the beauty on these properties, is that there's a lack of affordable housing across the United States. We start to see rents in Dallas or Atlanta, $1,300, $1,400, $1,500, $1,700 to rent a property, a unit. That means that you have to be making $3,000, $4,000 a month to pay that, plus utilities. I mean, it does get expensive. So a lot of people retire to these mobile home communities in these areas that are fairly reasonable and affordable. So I actually think the mobile home park community space is going to get larger, not smaller, but you also have to have communities that adapt to them, that want to affect people's lives with affordability. So you're not going to have that in Los Angeles, but you may have it out in Hemet. You're not going to have that in Dallas, but you may have that out in Granbury or someplace else that's a little bit less expensive than you are in the Dallas-Fort Worth area. So Robert is your guy to talk to. Robert, if somebody wanted to get more information about a little bit about what you do, what's the best thing for them to do?
Sure. Email or call is fine. I can be reached at 972-755-5229. Feel free to reach out and we'll see what we can do to help you.
Yeah, one more time, Robert Denninger with Marcus & Millichap out of their Dallas office. One more time with your telephone number again.
Sure. It's 972-755-5229.
All right. That's Robert Denninger with Marcus & Millichap. We certainly do appreciate that. James Zhang, always great questions. Just keep them coming. I do appreciate that too. Again, I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.